This is a question debrief of a September-December 2025 exam based on due diligence. And through this question, we're really just going to understand that this is not a difficult topic at all. Before we look at the past exam question and look at its answer, let's just quickly remind ourselves what a due diligence engagement actually is. In simple terms, this is a transaction-focused assignment, which is usually done by a firm for a buyer who's looking to acquire a target company. We're going to help them decide whether this deal makes commercial sense. It is not an audit, and we're not giving an audit opinion. The focus is on helping the client understand what they're really buying. The key purpose is to confirm the target company's financial position and performance, identify any major risks like hidden liabilities, tax exposures, or aggressive accounting, and help them assess whether the reported earnings as well as the future forecasts are actually sustainable. Please remember that in due diligence engagements, we also aim to quantify issues so that potential changes to the price that the acquiring company is offering can be looked at. To do this assignment, the firm is going to rely on procedures which are quite similar to audit. So we'll be carrying out analytical reviews. We're going to be testing high-risk areas such as revenue, inventory, provisions, tax-related parties, etc. But this is all going to be based on the information given in the scenario as well as the requirement. We'll look for unusual trends. We'll inspect different documents, use confirmations and calculations where needed. The end result is basically a commercially focused report that highlights the key risks and quantifies the likely adjustments which can affect the price that is being offered to the target company. So that's the concept behind a due diligence engagement. This is a section B question for 25 marks, and as always, it will be split into 20 technical marks and 5 professional skills marks. Please remember, for the professional skills marks, there's nothing extra that needs to be done as long as you're answering the requirement, giving good quality answers, and for example, in this question, focusing on areas or key risks which cover judgment, etc., you're good to go. Now, using information in Exhibit 1 only, we have to discuss the ethical and professional matters which should be considered by the firm before tendering for the due diligence engagement. Now, 10 marks basically means we're looking at 10 distinct points which are properly explained and evaluated. This is very generic that needs to be applied to the scenario. So I'll show you a list of acceptance and continuance considerations that can be applied to any engagement. But in AAA, there are no marks for like straightforward testing. We are going to use the information given in Exhibit 1 to evaluate those matters. So things like, are there concerns about resources in terms of time, staff, experience? Are there any ethical issues that need to be managed? Are there any concerns about client integrity, etc.? So we look at all of that for 10 marks. Then with just Exhibit 2 on the left-hand side of your screen, we have to discuss why the investigation should focus on warranty obligations for 4 marks. I haven't read the scenario yet, but I know from my preparation that warranties are accounting estimates. They have a lot of judgment. They're often complex. There's uncertainty because things are going to be clearer in the future. And therefore, this is going to be a problematic or risky area. So that's the discussion based on the information given in the scenario that we are going to be doing for B1. For the next one, we have to recommend the due diligence procedures which should be performed in relation to the obligation of the target company for 6 marks. So we're going to be looking at 6 procedures. Remember, for procedure, you need to have a source and a purpose. And again, this is going to be focused on the scenario information given. Like I said earlier, the professional skills marks are incorporated in the answer. There's nothing extra that you need to do about this. But just one point that I want you to please remember is whenever you have an acceptance question, you always have at least 1 mark for giving a conclusion whether this should or should not be accepted. So sometimes the marking scheme would have a technical as well as a professional skill mark, or sometimes it's just the professional skill mark. So there's minimum 1 mark, which is your professional skills for coming to a conclusion regarding acceptance decisions. This could be for this question, such as due diligence. It could be for any other engagement, including audit. So as I read the scenario, I was quite all right. I know the word due diligence scares me a bit, but I understand what the requirement is. So if I start reading the information slowly, I should be able to apply my knowledge to the scenario given. My recommended approach for both sections A and B in the exam is I would want you to read the scenario very quickly just to understand the information that is given before you start planning your answer. So if I always say read it like, you're reading news on the website or a newspaper just to understand what has happened. Section B scenarios are shorter, so this is going to be quite quick for you, because I'll tell you why. If you just start reading the sentence from the get-go and try to look for answers, you won't be able to create that link. So I would recommend you read the scenario quickly once to understand what's given, and then read it the second time and start planning your answer. So you can start picking up the information and maybe start converting it into an outline that you can expand on later on. Now, this is what I spoke about earlier. I'm now going to put in the writing time available as well. For acceptance considerations, we're looking at 10 points, and I would recommend using the 1.5 minute per mark rule, and this is the writing time available. This excludes the reading time. So I am going to spend 15 minutes and write as much as I can. It could be more or less than 10 points. I'm not going to worry about that. Just answer whatever I can within the allocated time. I know from my memory that I need to link information to resources, experience, ethical issues, etc. For the second part, for 4 marks within 6 minutes, I am going to remember that warranty is an accounting estimate. It has uncertainty, it has subjectivity, it's going to be subject to management bias, it could be manipulated, and therefore I need to focus my answer on these points. And then for the last one, for 6 marks, I am going to spend about 9 minutes in writing as many procedures as I can. Remember, when you write the procedure, make sure you have the source document clear and the purpose. So what are you looking at and why? That makes a complete 1 mark answer. And basically, my procedures are going to be designed to focus on the concerns I've raised in the earlier part. So how do I evaluate management's assumptions? I need to, of course, carry out an independent estimate of the warranty myself. Look at any indication after the year end, whether that, liability that the client has, target company has recorded, whether that makes sense. So all of that is going to be looked at. Now, I would recommend that you read the entire scenario once on your own before you start watching the rest of the video, because I am just now going to continue reading it as a student and annotating my points, assuming I'm doing it for the second time. Now, it is the 1st of July. You're a manager in the transaction advisory department of a large global firm of chartered certified accountants. Your firm has offices in over 100 countries and has a broad range of clients, including a number of large, well-known multinational companies. Now, this information is not given just like, oh, just because there has to be something there. In my acceptance part, the considerations, this implies that there is competence, there is experience, there is expertise, because they have a transaction advisory department and they have a broad range of compliance, but it doesn't tell me whether they have any free staff available. So you do, by the way, get marks for saying that the competence, experience, expertise remains okay or seems to be okay because of this information, but my concern is regarding the staff being available. And because they have offices in over 100 companies, as I've read the entire scenario once, I know that I would need offices in other locations. So I could link that part that, they could have their local offices doing some of the overseas work. I am only able to write this down, by the way, because I'm reading the scenario for the second time. You've been contacted about one of the firm's existing clients, which is a large unlisted company which manufactures cars. So it's an existing audit client, which means it is going to be a new engagement, but I already have a relationship with them. So I already carry out statutory audit for them. The following exhibits are given. Remember, for the first part, we use exhibit 1. For the second part, we use exhibit 2. I'm going to start looking at exhibit 1 now. So the client is an existing long-standing client of the company. And again, like I said, the relationship has already been there, but this is a new engagement that we're going to be doing for them. The directors wish to expand the company brand into the country of Farland, so it's overseas, by acquiring another company with a strong presence in the market, and they have identified Bright as a target company. So that's my company that I'm going to be carrying out a due diligence on. To satisfy other stakeholders, including the providers of finance who will be needed to assist in funding the acquisition, Kerr has to recruit a large reputable firm of accountants to perform a complete financial, operational, and legal due diligence service. Now, there are a couple of indications over here. When I say that they are going to be providers of finance who are going to be using my report, these are my users. So it's not just the board who I am going to be reporting to. There's a concern that, when you have the person that you give the report to, there are concerns that the users could be people or parties other than the board of directors, which could mean greater professional liability for me. In case I mess up my work and I'm negligent, then the damages will need to be paid to the providers of finance as well. Now, I'm just going to stop here for a second and just quickly look at what the due diligence terms mean. So there's a financial due diligence, there's operational, and there's legal. So basically, as the acquiring company is looking at a target company, which is Bright, they've asked the accountants to carry out an independent investigation so that they can reduce the risk and support the investment decision, right? So as a part of this, they want financial due diligence, which basically focuses on checking whether the profit, assets, liabilities, cash flows, etc. are reliable. And the focus would be on evaluating the numbers so that they can identify any financial risks or maybe even misstatements in the information given. Operational due diligence looks at how the business is actually run, its systems, its processes, and its people. And this is done to assess whether the operations are sustainable in the longer term and they fit with future plans. Legal due diligence is carried out to identify any legal risks such as contracts, litigation, etc. Right? So as a part of a due diligence, we are going to be looking at all three of these areas. Now, following initial discussions between the management team and Bright, the directors have been granted a 4-week period of exclusivity, which is due to commence 2 weeks from now. During this time, the directors and their advisors will have right to the accounting records of Bright in order to place a takeover bid. So once the assignment starts, whoever has been appointed as the service provider, they will have 4 weeks to get any information that they want from Bright. The directors therefore need the due diligence process to be completed in sufficient time to enable them to place a bid before this period expires. So the time frame is quite short. I'm going to link this to my answer. They need to make a decision in 2 weeks, so I'll have to, of course, prepare my bid. And then once the time period starts, the actual assignment is going to be 4 weeks or lesser, depending on when we actually start. So remember, all this information is given so that you can link it to time pressure and combine it with the resources element that we discussed earlier. So I'm just going to write that this basically indicates that there is time pressure that I need to consider. Now, several firms have been invited to tender for this engagement, and this would be performed as an agreed upon procedure. Even if they had not written this line, we know in an agreed upon procedure, we do not give any assurance at all. The separate transaction advisory department would carry out the work if the tender was successful, which means that the teams would already be segregated. You get no marks for talking about this as a safeguard. Now, interesting stuff coming up. The audit manager is available to assist in the engagement given the time scale and has current knowledge and experience. Now, amazing, this person has the experience, but if the same individual is also involved in due diligence, there is going to be self-review, which basically means if we want to use the expertise of the manager, we would need to remove them from the audit team. Okay, so remember this as I write my answer. So I'm going to explain self-review and then say, oh, this person needs to be removed because for this person, the self-review cannot be managed without removing them from the team. However, the finance director has stated that although other firms have been invited to tender, they are keen for this firm, us, to be appointed because the firm has always, the board has always been satisfied with the services provided because it's a long-standing audit engagement. Now, again, this information is not just given FYI. The board wants the existing auditors to carry out this engagement because they're happy with this team's work. But we need to understand this team is not going to be carrying out the engagement. It's going to be the same firm, but the team is going to be different. So as I do my ethical evaluation, there is a familiarity threat because they have a close relationship, they trust us, but we have to clarify to them that we cannot use this audit team. This will be done by a completely different team. The last paragraph on this screen, the due diligence service has been put out to tender at the instruction of the audit committee and tenders are to be submitted next week. And again, this basically gives us lesser time to prepare that tender. So we're just linking all the information given. I am able to carry out this discussion or planning in the exam because I've read the requirements and I know exactly what needs to be done. We then have Exhibit 2. If we read this information slowly, by the way, together, then the answer will be much quicker. So Exhibit 2 is what we're going to use for the warranties, right? So Bright is a medium-sized car manufacturer. They have a head office and several factories throughout the foreign country of Thailand. So we already know this is overseas. Their cars have been successful and they are sold with a 7-year warranty. Remember, this is what we're going to focus on for the rest of the part. The provision of the warranty is not accounted for as a separate obligation. The company's finance director is responsible for estimating the value. So really, they have a warranty. It's estimated by the finance director. And basically, they are going to be looking at the future obligations that could arise from the sale of goods under warranty. Now, please remember, stopping here for a second, we need to understand why it's important to us. We're not doing an external audit in this engagement, but as the acquiring company, these obligations become my headache after I acquire the target company. So I need to know how much of this obligation I will be taking up and therefore ultimately the cash outflow in the future. This is why the focus is on warranties. It has uncertainty, but I still need some estimation of how much I'm going to be paying based on the revenue that has already been earned by the company or will be earned in the future. Starting off with the first part now, we are looking at the ethical and professional matters. Because I've done my planning, I can now get my easy marks. This is a checklist that you can use for all your other engagements. You have to evaluate client integrity based on the information given in the scenario. Competence, capabilities, resources. This includes their experience as well as their qualification or technical ability. Resources basically means your time, staff. We look at ethical requirements, any concerns that could affect the quality of work, commercial considerations. So is the money good enough for a specialized assignment? If it's too high, there's a problem because my objectivity could be compromised. I'm getting a lot of money. If it's too low, that's a problem because quality could be compromised. For new or existing clients, we need to carry out customer due diligence, which is basically a part of your money laundering requirement. And for assurance engagements, which doesn't apply to this question, but we also have something called preconditions. So preconditions will not apply over here because this is not an assurance engagement, but this is a comprehensive checklist that you can apply to all other engagements. I can start writing my answer. We're focusing on the examiner's feedback. So the examiner said, I'm going to give you up to 2 marks for talking about engagement, acceptance, and continuance of the client relationship. So remember, it's a new engagement, but it's a continuing relationship because I already work for this client. So I need to see if this is, again, the examiner's answer, but simplified. For 2 super easy marks, I need to see if I have the ability to carry out the engagement in accordance with standards. Although this is an existing client, I will still have to evaluate the management's integrity and ethical values. And because it's an existing relationship, I could actually just find out if there were any problems identified during the audit which could affect this decision. So I've been doing the audit, but I found some information based on which I don't think I want to do any further work for them. So integrity and ethical values, recheck client identification, so the customer due diligence, and see if there's any information obtained during the audit which could affect my decision to carry out another engagement for them. So up to 2 marks for having this discussion. I need to look at the time available to complete the engagement. This is a tighter time frame as opposed to just general information given. We should only submit this tender if we know we can carry out the work without compromising on our competence and due care. So we have to submit the tender by next week. The client will review it, they will choose the firm, and then ultimately we will have less than 4 weeks, which is the exclusivity period, to complete that engagement. So 1 mark, you don't have to write all of this, just explain that because there's a shorter time frame, we will have to evaluate whether we can complete this engagement without compromising on our competence. If you write it exactly like this, you get a complete mark. We also need to see if we have existing staff with the required competence, and if not, we might need to get an expert or outsource some of the work. So I start by creating that link. They already have industry experience and an experienced transaction team. However, are they available to work on this right now? So we will need to make sure that we can carry out the full due diligence within the short time scale, and we can consider using an expert if it is needed. The staff element, so you could have all the amazing staff in the world, but if they're allocated to other engagements already, you might upset the other clients. So you need to see if they are available at a short notice. So experience was separate, staff was separate. There is going to be a requirement to have local knowledge because remember the legal aspect in particular and operational as well, it is in a different country. So we will need to see if we have location specific knowledge that is going to be needed. And honestly, because this is a firm which has offices across the globe, we could actually benefit from using offices, local offices from our network firm. The fact that we have or could have offices in the local area is also an advantage because we might need to carry out physical visits, particularly for the operational review. So although the financial and legal aspects can be looked at sitting at the head office in our home country, for operational review, it is likely to require visits to factories. So we might need to consider whether we have available staff to do this. Again, we can use staff from local offices. So see how the marks are given quite easily. Your experience, your staff, local knowledge for the legal aspect, potential visits for the operational aspect. We're just using the scenario and breaking down our marks. We need to clarify who the users of the report are, and we're going to link it to the second point as well. Now, the risk is higher because there are going to be other stakeholders who are relying on this report, such as the finance providers. We can discuss that our due diligence report should be restricted to the directors only. My concern is if later on there's a problem in my work, which could be, I could be amazing, but still end up making a mistake, then I might be liable to people other than the directors. So if this turns out to be a poor acquisition and later on, the finance providers could end up suing me for negligence. So I could clarify that I do not want the finance providers or anyone other than the directors to be relying on the report. You can distribute them for information purposes, I don't care, but I'm not going to be liable later on to anyone other than the board of directors. We start then discussing our ethical threats. You can pause and read this on your own. I'm not going to read through this, but it's quite simple. There's a self-review threat arises because of a number of reasons. You could link it to the current situation or the future, but for the manager in particular, the threat can be safeguarded by removing them from the engagement team. Please remember, you need to explain the self-review threat. So when they recheck the work that they've already done, they will not identify problems properly, or they will not review the forecasts or assumptions properly. So the explanation part is very important. If you simply write self-review, you're unlikely to get any marks because it's not explained. We also have management threat because the advice in proceeding with the acquisition or the price to offer is a part of management responsibility. So to safeguard this, we should clarify that management is going to be responsible and we're just going to give you the report and then you keep your decisions to yourself and make your decisions based on your own assessment. Regarding what the board had said, there's a familiarity threat. Again, please make sure you explain it because of the close relationship, our objectivity could be compromised, but we need to clarify that the transaction advisory department is going to carry out the work, not the audit team, and the board therefore needs to be comfortable with this. We have to make sure we maintain confidentiality because we're going to have access to information about Bright in that 4-week time period that no one else has access to. So we need to maintain confidentiality. We need to make sure that the fee is sufficient for this specialized engagement, not too high, not too low. And like I said, you then have to give a conclusion regarding what can be done. So I'm not saying don't do it. I'm just saying carefully evaluate and manage these before you accept the engagement. Within these answers, your professional skills marks are already there. So when you spoke about confidentiality, when you spoke about upsetting other clients, if you take away human resource and put them on this due diligence engagements, etc., you are going to be getting your professional skills marks automatically in addition to your technical marks. The second part was why they should focus on warranty obligations. Remember, this obligation will affect the price that we offer, and therefore we need to just focus on the why it is an important element. A generic discussion, it is going to affect future cash outflows. We will be taking on their liability and we will be paying this in the future when these warranties are claimed. The company valuation is going to be based on future cash flows which are discounted to their present value. So not just the future cash flows, we have to make sure that they have been discounted to the present value so that I know what the impact on my decision is. I will be alert to the fact that the warranties or the liabilities could be manipulated, particularly because this is being decided by the finance director. So they might have made inappropriate judgments to show lesser liability because that's what they would want to do. And this is an area which could affect my acceptance decision. So due diligence will help you identify issues that could stop me from acquiring this company. It could stop me from offering like maybe a greater price. It would affect the price that I offer. So any unforeseen costs regarding this need to be identified now. I need to know the level of uncertainty that is there in these outflows because knowing these upfront costs right now will actually help me evaluate whether this is a sensible decision. Um, there are two further points I'm going to talk about. The fact that the cost itself is going to be quite big. This is a manufacturing company, and particularly if there were concerns regarding a whole batch of cars manufactured, the amount of the claim could be higher, and the uncertainty is higher because it is a 7-year time period. So it's a problem because the money is going to be more. It's a problem because the time period is longer. So as the time period is longer, the uncertainty in the costs is going to be longer as well. So we've discussed about 6 points. You could, of course, pick up any 4. I would have said the uncertainty in the time period, the management bias, the judgment, these were the easy marks. We are now ready to recommend procedures regarding the warranty obligation. I've written them simply, so you can pause and look at them, read them in your own time. Remember, we need to focus on the what and the why. So the source and the purpose. So I'll start off by looking at actually the terms that are offered to the customers to understand which faults are exactly covered. So I need to clarify the scope of the coverage. I can start by looking at the warranty terms as the practitioner. I'm going to ask the management of Bright what their methodology is, what their assumptions are, so that I can evaluate whether that is reasonable. I need to see how accurately the year-end estimates reflect the likely costs. So discussion of the methodology, basically to evaluate whether their estimation is reasonable or not. I am going to review and recalculate the discount rate and the present value, again to check the reasonableness and accuracy of the calculations. So an easy mark for making sure the discount rate is appropriate, and then recalculate the present value using the discount rate. I could look at the repairs and rectification costs analytically. So a comparison, I could carry out an analytical review to compare actual costs with final estimates and the future cash flows. So historically, what was the estimate? What were the actual costs? And I could do that for post-year-end work as well. This way, I would be able to identify any trends and any unusual increases which could indicate that there are specific technical faults that come up quite frequently. So I'm looking at the cost to compare with actual in the first one, and then I am looking at the trends in the costs to identify if there were any unusual increases that may indicate specific technical faults which are repeatedly occurring. And I would know even for revenue that I've earned to date, that Bright has earned to date, I could forecast the warranty claims that could come for that particular technical issue. I could also ask or have a discussion with the production or quality control department to identify any technical faults that have already occurred and whether they were resolved or they were still pending. In all circumstances, I'm trying to evaluate the claims that are potentially going to come up in the future. So management discussion, particularly someone from the quality department, would give you that comfort over this area or estimate. I could also look at a warranty claim records and discuss trends with the management to ensure historical problems have been properly accounted for in the estimate. So in the past, whatever problems were, have they been fixed, or are they continuing? Have they been considered when the estimate was being made? After I've done all the checking of their work, I need to make sure I calculate an independent estimate myself. For accounting estimates, of course, go on to check their basis, but I need to carry out an independent estimation myself. So calculate an independent forecast of cash outflows and compare it with the management's. Like I said, your post-year-end work is also going to be very important. They had created a provision of, say, 7 million, and after the year end, they've already received claims of 6.2 million, and they still have quite a few while to go. So that means that the estimation that was done by the management has not been done correctly. So post year-end claims will also give you indication about the accuracy of the accounting estimate. All the procedures that I've done, they can be applied to multiple periods to assess whether the estimation process is consistent. It is a 7-year time period. Things are going to change, technical faults are going to change, the claims are going to change. So don't just restrict your evaluation to 1 or 2 years like we do in audit. This needs to be done over a longer time period to identify the estimation or the appropriateness of the estimation that the management has been doing. So if you just consider what we've covered up till now, none of this was really linked to the scenario. It was more understanding what the concerns were regarding the amount, future cash outflows, discount rate, time period, etc., and designing procedures to get further information about that warranty provision that Bright & Co has done.